Controlled Foreign Company, so-called CFC rules, are an effective tool that many countries use to combat tax base erosion. They're useful because they allow for the targeting of specific types of income in specific countries and circumstances. In this video, we explain how they work, which countries use them, and how you can mitigate them. To understand how CFC rules work, it is necessary to first define what a controlled foreign company is. A CFC, as the name suggests, is a company that you either own, co-own, or control, but that is not registered in your country of residence and therefore qualifies as a non-resident for tax purposes in your home country. This may sound confusing, so let's go over it one more time. Essentially, if your company is foreign registered but tax resident in the country where you live, due to place of management, permanent establishment, or other means, then it is not a CFC, and CFC rules do not apply. This means if the operational work for this foreign company is being done from your country of residence, CFC rules are not relevant. And even if the previously mentioned criteria are met, your company may not be considered a CFC. Most countries have their own specific requirements that have to be looked at individually. These specific qualifications often include type of income generated, the tax situation of the company, and the level of control each owner has. In most cases, only companies that derive the majority of their revenue from passive sources are targeted. With that out of the way, let us return now to our main topic. Explaining how CFC rules work can be difficult due to implementation differences between countries, but in short, they aim to eliminate any potentially gained tax advantage by shifting profits to such a CFC registered in a more tax-friendly country. Governments achieve this by requiring the attribution of the CFC's profits to the owners in proportion to their controlling interest, and then taxing those attributed profits in the parent jurisdiction, more specifically, where the holder resides, even if those profits are not paid out to these shareholders. To reiterate, the rules have no effect on the CFC itself, and it is never subject to additional taxes. These rules apply only to the owners. We've prepared 2 case studies to demonstrate how these rules work in practice. Situation number 1. Freedom Solutions Limited is a Hong Kong-based holding company. Richard, a New Zealand citizen and tax resident, owns 45% of it. Freedom Solutions Limited was formed solely to hold the shares of several companies in which Richard and his business partner Robert have invested. Freedom Solutions Limited is a CFC under New Zealand's CFC rules because it is owned by a New Zealand tax resident and earns more than 10% of its income from passive sources. As a result, for New Zealand tax purposes, 45% of its profits are attributed to Richard and are subject to New Zealand taxation. Situation number 2. Bitcoin LLC is a UAE company based in Dubai. Satoshi Nakamoto, a Japanese citizen and tax resident, owns it. Bitcoin LLC was formed to serve as the second partner in a UK LLP owned by Satoshi, but does not operate from Japan. The UAE company was created so that Satoshi could attribute some of the LLP profits to it and thus avoid Japanese taxation. Bitcoin LLC, on the other hand, qualifies as a CFC under Japan's CFC rules because it is owned by a Japanese tax resident and has an effective tax rate of less than 20%. As a result, for Japanese tax purposes, its entire income is attributed to Satoshi and subject to regular Japanese taxation. In this case, the CFC rules not only eliminate any benefits that such a structure would normally provide, but also add unnecessary complexities and costs. This leaves us with the last question. How can we mitigate or avoid CFC rules? The simplest and most effective mitigation strategy is to relocate personally to a country that does not have CFC regulations. A list of such countries can be found in the link in the description. Other strategies exist, but their implementation is frequently highly complex, not to mention costly. Working with an internationally experienced tax lawyer in your country of residence to explore what strategies may be available to you, depending on your circumstances, would be recommended.